Okay, assurance. We've already discussed the audit committee, guys, and we said the audit committee have to report on the independence of the external auditors. They have to approve their non-assurance services. They have to report on whether they believe that they fulfilled their duties and roles. They have to make sure that they are still independent in terms of how long they have been the auditors. Then for internal audit, they need to report on the effectiveness of internal audit, the effectiveness of the finance function and the CEO or the CFO. And they've got to make sure that they are comfortable with the fair presentation of the financials, so they've got roles and responsibilities there. So now we're looking at the specific assurance services, which would then be done by the external audit and the internal audit. But what we can already say is that they are both assessed by the audit committee. And internal audit needs to report to the audit committee. Okay, what I've said here is the governing body is responsible for assurance, but they can delegate to the audit committee, which is what they do. Okay. And their duties that the governing body have to do. So this is also important. This is not the duties for individuals. They need to ensure the integrity of external reports. So from the external auditors. They need to approve the internal audit charter and the appointment of the internal audit and the chief audit executive. They monitor internal auditors following a risk-based approach, even though it's your audit committee that will assess internal audits. They need to ensure that internal audit provides overall statements on the effectiveness of the company, its risks, and its control process. And they need to ensure independent quality review of internal audits is conducted 1 to every 5 years. The board. This is all the board, guys. But what you are seeing through this is some responsibilities of internal audit. So I can now go and see that internal audits need to do a statement annually where they assess the effectiveness of the company. Internal audit needs to follow a risk-based approach. Internal audit need to adhere to the internal audit charter. Okay, so through this governing body duty, I can start to pull out the duties of internal audit because they don't give you the duties of internal audit separately like they used to in King 3. Okay, so you might get a question that is focused on internal audit and you don't know where to find the answers on internal audit. Then you need to go to assurance, see what the governing body's responsibility is that deals with internal audits and see what they're supposed to be monitoring. And then you can pull out what internal audit we're supposed to be doing. So if we go to Principle 15, we can see here that it's the board's responsibility to assume responsibility for assurance, which they can delegate to the audit committee. But the objectives here are to ensure that there is effective control, integrity of external reports, and integrity of information. And through this, they should ensure that the organization functions on its own, that there is internal audit, that there is external audit. They must make sure that the external audit reports are correct, ultimately. And then for internal audit, I've put down the responsibilities. Okay, and here we can see everything that the board is responsible for, but through that I can start to pick up what internal audit should be doing. Board is responsible to make sure that they have internal audits that follow risk-based approach. So I know that internal audits have to do that. That internal audit provides a statement annually, so I know internal audits have to do that. Okay, now what I've done here, guys, is there's a nice summary of where the Companies Act and the King reports actually have interrelated topics, and how we can see how they speaking the exact same language. So the report is now aligning completely with the legislation, or slight differences, but once again, legislation will overrule the report if there is a slight difference. So for directors' conduct, if we go to section 76 of the Companies Act, it explains how directors should act in terms of the best interest and good faith, and then Principle 1 of King says the same thing. So the two now, when in a question I see that a director isn't acting in good faith, then I can discuss it from both aspects, the King requirements and the Companies Act requirements. Okay, once again, we discussed earlier how the Principle 4 says the governing body needs to be alert to the liquidity and the solvency of a company, and we know in terms of the Companies Act, Section 4, the liquidity and solvency need to be monitored, and in the Companies Act for specific transactions, liquidity and solvency need to be considered before that transaction can actually be approved or authorized. Okay, so once again, when I get a set of financials and I can compare assets to liabilities and current assets to current liabilities, when I pick up that there's issues there, I can now discuss it from both aspects. Okay, annual financial statements, section 30 discusses how we have to have them from a Companies Act perspective, and Principle 5 says we need to have them from a King perspective, specifically also discussing the integrated reports and the requirements there. In a question when we see that they are appointing directors now, once again, we can discuss it from a Companies Act perspective. Are the shareholders able to authorize the appointment of directors? And then from Principle 7 in the King, which says that you've got your nomination committee plus the board who need to authorize the nominations, and then the shareholders will appoint them, elect those at the shareholders meeting annually. Disclosure of directors' interests. So from a Companies Act, it's your section 75. Very important to always remember all the criteria, and as soon as we see that there is an interest, to discuss whether they have complied when voting on a decision that takes that interest into account. Now we can discuss it also from King's perspective. The fact that, first of all, directors have to disclose their interest, but also we can also discuss it from Principle 1's perspective with regards to if there's a conflict of interest. Okay, the Audit Committee, so Section 94 of the Companies Act discusses who needs to be involved in that Audit Committee, or who the members need to be, and the duties that they have. And then your Principle 8 in King discusses that further. Okay, and they align the fact that there should be at least 3 non-executive, and then King specifically highlighting that they should be independent. Okay, so we add that there. And the fact that they need to have the knowledge to be able to do the duties that they need to be doing with regards to external audit, internal audit, and their finance department and their financial functions. Okay, Company Secretary, Section 86 and 89 of the Companies Act deal with appointment and removal, and how the board are going to be responsible for that. And then your Principle 10 in King once again highlights the same requirements. And then finally, the approval of directors' remuneration. Section 66 of the Companies Act says there needs to be that special resolution. Principle 14 of the King slightly differs in that it says that the board will approve the remuneration policy that will have been developed by the Remuneration Committee. The shareholders at their AGM will pass a non-binding advisory note on that remuneration policy. So non-binding means whatever their decision is doesn't impact the board's approval. So if the board have approved it, it's approved. So non-binding and advisory, it's just giving advice on that decision. So the board approved it, it sticks. But the shareholders will just make some comments on it. So yes, I'm happy with that, or no, I don't agree with this. It sticks, but you guys need to be aware we're not comfortable with this. And ultimately, there needs to be some kind of relooking at this policy, even though it will remain based on the board decision. But remember, if 25% or more of the shareholders voted against that remuneration policy, there's a bit of a concern with regards to it. That needs to be disclosed, and there needs to be a relooking at that policy because the shareholders are not entirely comfortable. But once again, it still stands. Even though they have to relook, the decision still stands. The remuneration policy is adhered to because of the board. So there's that difference between Companies Act and King. The Companies Act says shareholders approve directors' remuneration according to a special resolution. King, only the shareholders pass a special resolution with regards to non-executive fees, but with regards to the actual policy, board actually have authority over that. Class question, comrades, guys. It is a longish question, so I've given you the 12 minutes reading time. However, it's only out of 26, so your writing time is 39 minutes. You should be able to get through this in the reading time and the writing time. I've addressed this already. It covers both Companies Act and King, testing the governance of a business through those two acts and codes. Okay,